Welcome back to Happy Investors with a new analysis of Netflix. We share short analyses for stocks on our YouTube channel, as well as inspiration for ETF investing and similar topics. And note, this analysis of Netflix is purely about the access to our data tools that we have to share with you, just for inspiration and also some value to give to you, just because we can. Subscribe for more analyses and inspirations, of course. But do note that this analysis of Netflix is purely quantitative, data-driven, and based on our tools. And we will not discuss our own research on fundamental quality. Is it a good company? What is leadership? What is intrinsic value? We look at it purely from our tools. Short, but powerful. Do you have questions? Let me know. Then, we will answer them. And don't forget, if you appreciate it, like and share this video. Subscribe. And if you want more inspiration, visit our website. There you can download stock books, ETF books, and more for free. And also check out our analyses for growth, value, and dividend stocks that may outperform the market with higher returns. Speaking of Netflix, I don't think Netflix can achieve a higher than average return in the short term. The stock has risen quickly. If we look at the Morningstar value estimate, it is estimated at $550. That is significantly lower than the current price of $38. So either Netflix is extremely overvalued or Morningstar is completely off with their value analysis. The more well-known the stock, the more attention Morningstar pays to the valuation, but that doesn't mean they are right. They indicate that the economic moat is narrow. There is, of course, intense competition. However, I must say I am really quite impressed with Netflix. They are really taking good actions, maintaining good series and movies in which they invest. At least the movies might be a bit less good. But also, for example, recently, Mike Tyson appeared in the version with Jake Paul. By the way, Jake Paul does that really well from a marketing perspective, and Netflix is also responding well to it, making it available for their members. But, objectively speaking, it's all nice and good. However, Morningstar gives it 2 stars. And we will also see that based on factor analysis and also short term, the stock may indeed be overvalued. It is always very important to take historical valuation into account. Now, if you look at the long-term historical valuation, you often see that Netflix is above the fair value. The fair value line is the orange line. That is what could actually be a normal fair valuation for the stock. And companies, people, investors are willing to pay a premium for Netflix. But you see, Netflix has already dropped significantly once. That was also the moment when Bill Ackman sold almost at the bottom. And as a result, he lost a lot of returns. But yes, Bill Ackman is of course a very good investor. And everyone can look back on it, and we will all look back on it much more often than he will. So, let's forgive him. Netflix, the normal multiple is very high. So yes, if Netflix achieves an EPS of 20 and 20%, then you should actually look at the fair value multiple. Well, that will come out around 22. That is somewhat in line with, for example, Microsoft and what strong companies have like Alphabet and such. Then you have a price to earnings ratio of around 20. Only the current price earnings have risen significantly for Netflix. So either these estimates are incorrect and the market is inefficient, or the stock is simply overvalued. It seems that the latter is the case and that Netflix could indeed result in a painful loss from this price level. For at least the medium term and perhaps even for the very long term. If we look at the very long term, the estimate is made by 4 analysts, so not very many. That Netflix stock. And then we are talking about EPS growth, the earnings per share, that it can grow by 30% annually. Well, an annual EPS growth of 30% is significantly high. But let's assume that is the case. The current price earnings is high. But still, because the EPS growth is set so high, the stock can achieve a PE ratio of 30 over a very long term. And this is, of course, not a linear process. You know this better than anyone. There will be many moments when the stock will drop or rise significantly. But then it could theoretically achieve an average return of 70%. I think a price to earnings ratio of 21 is more justified. And that means even despite the very impressive growth, not taking strong competition into account for a moment, and the price to earnings ratio is 21 over the long term, then you could achieve an average return of 10%. And that is actually just a bit in line with the market average. So, yes, I think Netflix is not that super interesting. There seems to be more optimism than pessimism in this stock at the moment, and that usually turns out wrong. Looking purely objectively at quantitative data, the quant rating from Seeking Alpha is 3.48. This is mainly because the momentum is relatively high, but growth and profitability are also strong. And the valuation gets a low score because, yes, that price to earnings ratio is, of course, very high compared to the sector. Only the bad luck ratio, what is it all about in the end? And, of course, your long-term intrinsic, the valuation is 1.6, so that is not extremely high when you compare it to the sector median. But the question is, of course, how high the growth estimate is. But first, also look at the high price to cash flow and price to sales ratios. None of it is on the lower side, so it could all turn out to be quite disappointing. The growth estimates are still relatively on the higher side. Of course, this could all go wrong. You know better than anyone that when Netflix publishes again, subscriptions have decreased or stagnated, then that will lead to a huge reaction in the stock price, just like it was a few years ago. So it seems to me that if you have patience, you have a better chance of success with Netflix. Then if you make hasty decisions now, that return on equity is actually quite remarkably high. And also, the return on total capital is starting to become attractively high at this moment. So the company usually does really good business, good content, that sort of thing. Only yes, it is of course a question of how much they can still grow. That is always a concern. And the valuation is simply on the high side, at least in the short term. There seems to be downward risk. I consider it a hold. And their price target for the next 6 to 12 months is a slight increase to the price level of 850. Their analysis does see that the current price is well above the EPS graph, which was also the case here in 2020. It only takes a couple of setbacks, like 2 consecutive quarters, where subscribers stagnate or decline, and we end up in a situation like in 2021 where the stock has dropped, minus 70% or maybe even more. As I said, Bill Ackman completely exited here and thus missed a significant rebound of about 340% return. But, of course, it's forgiven if subscribers decrease on an online platform. What is not worth much in terms of book value anyway? Yes, then you have a lot of potential, risk and loss of money, and all I can say is that I regret not buying. Perhaps one of my big mistakes in the past period. I have been following Netflix for a long time and I haven't bought any myself. So, big mistake, as you can see, missed returns. I didn't expect it to rise so quickly again in such a short period. Only, yes, what you also see, although the momentum is very strong, is a solid negative trend. It sets new all-time highs. And stocks that consistently set new all-time highs often maintain strong momentum. However, when the valuation is so high, like Netflix, a market correction is very likely. And I would say a drop of 40% or 50% is actually nothing for these kinds of situations. But time will tell.